Welcome back to part 2 of the session where we will look at certain elements that Kihara has pointed out on the minimum disclosure documents. The first thing we are going to look at is going to be asset classes. So you will see a very funny or actually very strange image up here on the screen, but this would be a message that I received from a very close friend of mine yesterday evening, and this message reads as follows. This friend said, "Pack your bags, we're going away for the weekend." I replied, "This message made my day, where are we going?" My friend replied, "Found this place not too far, about a 2-hour drive, the perfect blend between nature, gorgeous view and hiking spots. We'll stay in the hotel lodge. They have really fancy restaurants so we can enjoy great food as well. Not keen for camping. I want feather pillows this time." I found this very funny, of course, and I asked, "So you're not in the mood for sleeping on the ground fighting with bugs?" My friend replied, laugh out loud, "No, I'm good. Not this time." What a shame. And of course I said, "I'm in." And what are you going to pack for this weekend? And my friend replied and said, "Just because my friend knows me so well, you and packing, it has a bit of everything: hiking, pool, nice restaurant and hotel. So make sure you pack the right shoes in. Hiking shoes with a dress to dinner wouldn't be ideal." So of course this sent my mind reeling, because I had a couple of decisions to make, and especially when it comes to shoes, decisions. Looking at going away for the weekend, I would have to pack my hiking boots, and I will look at adding a high heel or two, perhaps a stiletto like this or high heel like that, when it comes to dining out at the very fancy restaurant. So why do I have all different kinds of shoes up here on the screen? It is really to explain asset classes better, because in the same way we would collectively refer to hiking boots and flip-flops and trainers and work shoes as shoes. In the same way, everything you will see up here on the screen, whether it's equity or property or fixed income or cash, they would all be investment assets, which are grouped into specific classes, which we call an asset class. So within a class, it would actually be a grouping of investments that exhibit similar characteristics, and they would also be subject to the same laws and regulations. So all in all, within a specific asset class, these investment assets, let's say equity for example, would behave similarly in the marketplace. You will also see that we refer to certain investment assets as local and foreign. Local in our case, of course, being South African assets, and foreign assets being offshore assets in other jurisdictions. I'm now going to play a video that will explain these asset classes in better detail.
What is an asset class? An asset class is a group of financial securities that have similar characteristics. They behave similarly in the marketplace, and they are subject to the same laws and regulations. There are 5 main asset classes: equity or shares, property, fixed income, cash and cash equivalents, and alternatives. Alternatives include hedge funds, commodities, and private equity. Investments in different asset classes react differently to news. The same piece of news might be positive for equities or shares, negative for fixed income, positive or negative for alternatives. Equities are shares in the ownership of publicly owned businesses. Equity value goes up or down based on investors' perception of company performance. Historically, equities get the most return but also have the most volatility. Property can be homes, investment properties, or collection inside property funds. Property value tends to be more stable than equities, but can still go up or down sharply. Fixed income, like bonds and annuities, pay a fixed amount for a set number of years, then returns the principal to the buyer. Fixed income value movement is based on interest rates and is more stable than equities. Cash and cash equivalents includes cash and short-term liquid securities. Cash and cash equivalent value is considered the safest and least volatile. Diversification is owning investments across different asset classes. This lowers portfolio risk. Combining these different asset classes creates balance inside of your investment portfolio.
I think that was a very informative video, but just to sum it up on one slide, when it comes to a specific asset class, you will see we would have equity, and we have trainers or tackies up there on the screen just to make the association a bit easier. And of course, trainers or tackies would really be multi-purpose shoes. You can use it for running or weight training or trail running, so it has to be very durable. They have to be very tough, and they have to be in it for the long run. I mean, you would need your trainers to run a marathon, or at least they need to last a year or two, because they are very expensive. So it's a very aggressive purchase, if I can put it like that, if you buy tackies, of course, or trainers that are of good quality. And they need to be of good quality because they need to elevate your performance at the end of the day. In the same way, when it comes to equities, as you would have seen in the video, it really provides you with ownership when it comes to a company. The risk profile, when we just look at the specific asset class, would be aggressive. And here would be some examples, some of the sectors we find when it comes to JSE, and these would be some of the shares or the equity that we will actually find listed there, from Naspers to Absa Bank to Pick n Pay stores. And of course, there would be quite a number of them that you can buy. Advantages, it will provide you with a dividend stream and giving you some income in the meantime that comes in from the dividends that are being paid out, and of course also capital growth potential over time, because these shares would then hopefully increase in value. And then disadvantages would be they are exposed to the market, and of course one can never predict what will happen in the market. So that would be the shares or our tackies or trainers. Needs to be good quality. They need to be in it for the long run. You really want them to carry you right through over the finish line. Secondly would be our work shoes, which would be property. So whether you work in an office environment and you want to wear high heels because you want to create the right impression, or whether you work on a building site and you need to wear safety boots to protect your foot, it is all about the confidence you get from these shoes in doing your job. You're basically saying, I own this piece of land, or I own this project, I own this task. And in the same way, when it comes to property, you're actually then an owner, whether it's residential property or commercial property, whatever the case might be it brick and mortar, be it listed property. There you will see once again up on the screen, just to put it into perspective on one slide, is what we have also seen in the video. It being a little bit more aggressive, then of course some examples, and also the advantages and the disadvantages when it comes to property. Thirdly, when it comes to fixed income, you will see we have slippers up there on the screen. And why slippers? You know, when you have a very long day and you just want to go home and you just want to put on your warm and fuzzy pair of slippers so that you can relax and you can be comfortable. I mean, slippers are so reliable. They never disappoint, and they can actually be quite boring in that sense, I suppose. And that is exactly what I want to say, that is what the world of fixed income is like. But when we look at a bond, for instance, that is what we want a bond to be like. They just need to do what they need to do without taking on too much risk. There's not much excitement there, but at the end of the day, they need to achieve what we want them to achieve within your investment portfolio. So they need to be very stable in that regard. You will see then, of course, risk profile tends to be very cautious. There would be some examples, and of course the advantages and disadvantages of bonds. Next up would be the world of cash and cash equivalents. And now I know everyone is looking forward to the holidays, because you would see flip-flops that we have up there on the screen. And why flip-flops when it comes to cash? Flip-flops are very affordable, they are easy grab and go shoes, they are so versatile, they're comfortable, but I think most of all they really provide a sense of freedom or flexibility. I mean, you're only going to wear your flip-flops over the short term. They are not very durable, so you're not going to use them to run a marathon. In the same way, when we look at cash, it is really geared short term. That is why cash would provide us with a great sense of flexibility and freedom. Last but not least would be the asset class we call alternatives, or grouping a couple of alternatives together. All four of the asset classes we have looked at, including equity and property, fixed income, as well as cash, would be traditionally added to investment portfolios. Fairtrade is actually the first in South Africa to include alternative asset classes in their blended portfolio. So this is actually a non-traditional approach, because we use things like hedge funds and private equity and also commodities to give us a competitive advantage. When we refer back to the shoes, alternatives would really be like a pair of specialized shoes. Specialized shoes are very unique and they are designed for a specific purpose. They also need to provide you with the utmost comfort. We are referring to shoes such as spikes, for instance, or soccer boots or cycling shoes, because at the end of the day you would need a pair of these if you want to boost your performance and also to give you a competitive advantage. And that is exactly what having alternative assets in your portfolio would do when it comes to the performance of your investments. This would be worlds of forwards and features, options and warrants, and it can get very, very complicated, and a very high level of knowledge and expertise is necessary when it comes to managing these portfolios. We are now just going to play a short explanation on hedge funds. For the sake of this presentation, we won't go into a lot of detail. We will be looking at a couple of these alternative assets in our portfolio as we look at some of our solutions later on in the session. But as long as you understand that adding alternatives to your portfolio will really boost the performance of your portfolio and it will give you a competitive advantage.
Let's talk about hedge funds. Hedge funds are different to unit trusts. This means that unit trusts can only make money when the price of the security that it bought goes up. If you buy something for 100 Rand and sell it at a future price of 150 Rand, you make a 50 Rand profit because the price went up. With hedge funds, you can make money if the price goes up or down. It all depends on the position the hedge fund is holding. Let's illustrate this with a cell phone example. You believe that the value of an O phone will go up in the next year. Therefore, you are wanting to buy it now for cheaper at 15,000 Rand, as you plan to sell it at a higher price in future. You also believe that the value of a Samsung will go down in the next year. Therefore, if you buy Samsung today, it would be more expensive than if you waited and rather bought it at a cheaper future price. Because you believe that the price of Samsung will go down, you decide to borrow a physical Samsung phone valued at 15,000 Rand and then sell it to someone for 15,000 Rand. Your current cell phone portfolio is now holding a physical O phone valued at 15,000 Rand and 15,000 Rand cash from selling the borrowed Samsung phone. A year goes by and your predictions were correct. The O phone is more expensive, valued at 17,000 Rand, and the Samsung phone is now cheaper at 13,000 Rand. So what does this mean for your portfolio? The O phone went up in price. You bought it for 15,000 Rand and can now sell it for 17,000 Rand. This means on this investment, you made 2,000 Rand profit. A year ago, you borrowed a physical Samsung phone and sold it for 15,000 Rand. Now, you need to give the borrowed Samsung phone back. With the Samsung price going down, you sold it for 15,000 Rand a year ago and bought it back for 13,000 Rand a year later, so that you could return the borrowed device. With Samsung's price going down, it still gave your portfolio 2,000 Rand profit, leaving your portfolio with a 4,000 Rand total profit. Hedge funds can make money if the market goes up or down. It all depends on the position the hedge fund is holding.
Like I've previously mentioned, the world of hedge funds, or rather of using alternative assets, is very, very complicated. We have a lot of information available on our websites, articles, blogs, videos, so please go and take a look and you can upskill yourself in this area. The next question I'm going to tackle, because we have discussed all of these asset classes now, is how do all of these asset classes come together? And first and foremost, I want to touch on a very important principle before we dive into this. And this is a quote that Sir John Templeton actually put out there, and it says that asset allocation and diversification are the foundation stones of successful long-term investing. This is, however, simply not just a quote. This is actually backed up by a lot of research that has been done and that is currently being done in the investment space. So it really comes down to what is shown in the following image, that asset allocation is the main driver when it comes to performance. Yes, other factors will also play a role. For instance, security selection. There would be multiple other factors, and also market timing. That will be trying to time the market and jumping in and jumping out at the right time. However, when it comes to asset allocation, it remains the biggest portion of getting the performance that you need over a certain period of time. So what do we mean by asset allocation? Here you can see asset allocation refers to the fact that an investment portfolio will always consist of a blend of different asset classes in certain ratios. If we look at the portfolio up on the screen, you will see that it is exposed to multiple asset classes, equities, property, cash, as well as bonds, and a little bit of other assets. And you will see the majority of this exposure or allocation being to equities, which is over 74%. We will have property there almost 4%, cash almost 9%, just almost a 0.5 when it comes to others, and bonds almost reaching 13%. So if we look at a portfolio like this, we can see that it is geared towards the long term because of its high exposure to equities and also to property, and its low exposure to cash and bonds, which will generally be regarded as short-term investments when it comes to their grouping. I'm sure you would agree with me that comparing a portfolio like this to a portfolio that will hold, for instance, over 90% cash would be unfair, because we are not comparing apples with apples. We see this happen so often in the industry, where an investor would say, my investment is performing better than someone else's investment, but they are comparing two completely different investments to one another. Or you would run to your financial advisor saying, my investment is not giving me the same return as my neighbors, but at the end of the day, you might be invested in, let's say, an income fund, and they would be invested in a portfolio that has a massive exposure towards equities. And of course, over the long run, you cannot compare the performance of those two. So how do we try and even the playing field when it comes to comparing different funds or portfolios? The only way you can actually only do that is by using a benchmark. So what is a benchmark? By definition, it is a standard or point of reference against which things may be compared. So it really helps us to compare apples with apples. An example of this would be, or just to illustrate it a bit better, would be the qualifying time for the men's 100-meter sprint when it comes to the Olympics. Unfortunately, if you sprint the 100 meters in over 12 or 13 seconds, that would not be good enough to get you into the Olympic Games. This, however, would be the benchmark. But we all know that they sprint on a track. So would it be fair to time someone when you expect them to run the 100 meters over a gravel road or on a gravel road, or even in the mountains, being more like a trail running type of environment? It would not be fair. Or what if I had to ask you to run the 100 meters in stilettos or soccer boots or even in your slippers? Of course you will not qualify. So in the same way, we always need to go back to the benchmark. It would be very unfair to ask of a runner to run the 100 meters below 10 seconds if the external factors are really against them. So what do we use as a benchmark in the world of investments? As benchmarks, we use ASISA classifications. So ASISA is the Associations of Saving and Investments in South Africa, and these classifications or categories can actually help us then to compare different funds or portfolios, making sure that we compare apples with apples. So I have two different funds portfolios up here on the screen, and before I jump into them, I just quickly want to explain what the tiers that ASISA uses come down to. So I'm just going to use this one on the left as an example. Here you will see ASISA South African Multi-Asset High Equity. So they would basically look at 3 tiers to put together a certain classification. And South African, the first tier would be where. So whether it is South African or regional or global or worldwide, that will make up the first tier. The second tier here we'll see will be multi-asset. So this will mean it can actually invest across multiple asset classes, whether it's property or equity, whether it is cash or whether it is the fixed income space. And when it comes to the second tier, we will also find things like equity or real estate or interest bearing. The third tier will actually give details when it comes to the second tier, as it will carry specific definitions of the asset allocation. For instance, if we have asset classes here, this third tier can either be high equity or low equity, it can be medium equity, it can be flexible, it can be income, so it depends. At the end of the day, what it means if we had to look at a construct like this is multi-asset, as I've mentioned, would mean they, or let's say the portfolio manager or fund manager, can invest across multiple asset classes, whether it's equity, bonds, cash, or also then of course property. And the expectation when it comes to a South African multi-asset high equity classification would be short-term volatility. Why? Because of the high exposure to equities and property. Remember, they are volatile over the short term because they need to provide you with growth in the long term. And you can see really the aim of a construct like this would be long-term capital growth. Once again, that is why the equity and the property would have such a high allocation within this fund or portfolio. When we say high equity, it just really means, I'm just going to highlight one of this, is that the equity exposure can be up to 75%. So you can see it's just, well, it's almost 72%. So this will be a high equity fund or portfolio. So it would be very unfair to compare the performance of a portfolio or fund like you will see on the left to what we see on the right up here on the screen. Because when we look at the classification, you will see, yes, it is ASISA South African, it is multi-asset. However, this is income, it is not high equity. So what this would mean, you would see exposure to bonds being over 83%, and cash almost reaching 17%. So here would be no exposure to equities. Once again, if we just take a closer look, multi-asset, again, they can invest across multiple asset classes, and here you will see the expectation would be different. The primary objective would be maximizing income, so you will see it will be very different to the long-term capital growth that we will see on this side, and of course there won't be much short-term volatility in this space. So when we look at the exposure of this fund or portfolio, you will see that if they do include equity, it can only be up to 10% and not 75%. like we will find on the left here. So when you have a portfolio or you have a fund and you compare performance, please make sure that you don't make the mistake that a lot of investors out there make, and they compare two portfolios like what we have up here on the screen. Make sure that if you have a South African multi-asset high equity portfolio, you actually compare it with a South African multi-asset high equity portfolio, and the same when it comes to income. So there would be a lot of these classifications, but please just make sure that you place them within the same category. Why can't we compare the performance of these two portfolios? Because of their asset allocation. Remember, when it comes to bonds or cash or equities or properties, they have their very own risk profile, whether it tends to be more cautious or more aggressive, and this in turn will also mean that they can generate a specific return or an expected return. And we have illustrated this on this slide. You will see here that there will always be a risk and return trade-off. The higher the risk you are willing to take, the higher the expected return would be, and vice versa. So it's important to realize that you can't expect to shoot the lights out, but you're not willing to take a certain level of risk. If we had to look at the potential risk and the potential return attached to each one of these asset classes, we will have cash here, very conservative in terms of risk, and of course the return won't be that high. Next up we will have bonds. You can see a little bit aggressive but still very cautious. Once again, the returns won't be that high over the long term. Moving on to the more moderate space, we will have property, a bit of a higher return. Then of course equity being a little bit more aggressive, we can expect a higher return over the long term. And then of course the alternative assets that we have looked at tend to be a bit more aggressive, but then also once again giving you the competitive advantage in your portfolio if diversified and included correctly. There is, however, one slight exception when it comes to this graph, and that is the positioning of alternatives on it. I'm quickly going to hand over to my colleague Kihara, who will explain why alternatives are not always to be regarded as being aggressive. Thank you, Kihara.
Wonderful. Thank you so much, Salma. So just an important point to note on alternatives. Remember that inside alternatives, there were these additional assets or groups of assets within this group. So it's almost like a division within a division. And remember, these are obviously traded differently or act differently to one another as investments. And so although the alternatives as an overall group is generally placed on the aggressive side in terms of the potential for risk, we do see subcategories emerging, especially within the hedge fund space. And this is quite important to speak a bit on, especially with regard to our Fairtree funds. And so there is this myth going around, or belief in the market, that hedge funds are these very foreign, very risky type assets, where that is really not the case. And that largely has to do with the fact that hedge funds, much like normal unit trusts or long-only instruments that we use, they have underlying assets that make them up on the inside. So some of these hedge funds are even multi-asset. They range across all four of these different assets. Whereas you may have a hedge fund that's just trading in bonds or just trading in equity. And so that will also influence the risk of the hedge fund. So it may actually fall, if trading in your fixed income and credit instruments, for example, it may actually be a cautious hedge fund. If it's a hedge fund that has a balance of different assets and underlyings across bonds or fixed income, property and equity, that would be more to your moderate or moderately aggressive. So the risk of hedge funds is largely dependent on the assets being traded in the underlyings. Another important part when determining hedge fund risk is not only the assets being traded, but also a concept called
gearing. Gearing is basically a position taken out on a position, maybe even a third time taken out on a position again. And so hedge funds, remember with our video, you can take out different positions in the market. You can long or short a market. You can take out a put or a call strategy. And so there's these different strategies of buying which hedge funds can take on in the form of a position. And gearing would be potentially gearing a position on top of a position on top of a position. And so that also influences the level of risk inside of that portfolio. And we will be going through specific Fairtree hedge funds later on in this session, and you will see exactly where your lower risk hedge funds fall and your medium to high risk hedge funds fall. So it's quite an important thing to note that alternatives, although as a group holistically have been sort of bucketed under aggressive instruments, looking at hedge funds as a subdivision, it's not always simply aggressive. Salma, back over to you.
So as you have seen, when it comes to asset allocation, we need to have a mix of these to make sure that your portfolio caters for your need. This is also important when we look at the next concept, which is diversification, because it's very risky having all of our funds, for instance, only in equity, or even for that matter, having all the money that we have in cash over the long term. So what then really is diversification? Diversification usually means that you don't keep all of your eggs in one basket. So it's got to do with spreading your risk out a bit. So if one of the baskets do fall, then you will hopefully still have some eggs left in your other baskets. People would think diversification is just spreading out their portfolios across different asset classes or jurisdictions or asset managers, as we see up here on the screen. But is this truly diversification? So let's quickly take a look of what we do find in the industry. Let's say we have someone who has 900,000 Rand to invest and they have a time horizon of 5 years. This is typically what some of the investors would do. They will put, let's say, 2/3 of the money into ABC. ABC would, of course, refer to a specific asset manager. In this case, they would put 2/3 in ABC's equity fund, and they will put the balance, the 300,000, in ABC's money market fund. So they would think, I have now diversified because I have a time horizon of over 5 years. The majority of my money would be in the equity fund, which is geared towards long-term savings, and then of course the smaller part or the portion of my money would be in the money market fund, which is creating sort of a safety net or less volatile environment for me for the next 5 years. So is this really diversifying smartly? We're going to look at why most probably it's not in a second. Then secondly, they would think they're going to spread their portfolio over different jurisdictions. For instance, locally as well as offshore. They might take half of the money and put that into the equity fund with asset manager DEF, and the other half of the money they would invest in the global equity fund, so they have exposure then locally as well as globally. Once again, is this truly diversifying your portfolio or going about it correctly? We'll find out just now. And last but not least, and we find this a lot, is where investors think they can just spread their money between different asset managers, and then surely this is a proper diversification. So this investor chose to invest 300,000 Rand with ABC in their balanced fund, 300,000 with DEF in their balanced fund, and 300,000 with XYZ in their balanced fund. Is it, however, smart to diversify like that? So the very short answer would be not really, because diversification includes a lot of other factors as well that we need to keep in mind, like the risk and return characteristics when it comes to the different asset classes, and also the underlying assets within each particular asset class. Of course, the allocation when it comes to these asset classes, and then also the relationship between certain funds like we will see here, and then very importantly, correlation. And that is a concept that Kihara will explain a bit later on. At Fairtree, we have a very different take on how we see proper diversification within your investment portfolio. So it's not only about just throwing a couple of balanced funds into one pot, because there could be a lot of overlapping in terms of certain assets or even certain strategies. So let's bust that myth and look at a practical example. So here you will see the myth would be is combining balanced funds, really balanced investing. And like I've mentioned, we have a slightly different take on this, and up here on the screen we will actually run through, let's call it a live case, where we take two different investment portfolios, we run it through a wealth analyzer. A wealth analyzer will actually show exactly what the asset allocation with the specific portfolio would be, as well as the return that that asset allocation will achieve over time. So let's look at what I would call the standard portfolio in the industry when it comes to balanced investing. You will see here we have asset managers red, blue, gold, white and purple, and we have 5 then different balanced funds. Here you will see the weighting, so this just basically means I will give 35% of my investment portfolio and to asset manager red, and I will invest it in their balanced fund. The same with blue, giving them 20% and so forth. So this might look like diversification because I've spread my money between 5 different asset managers. However, let's see how it plays out when we compare it to our take on balanced investing when it comes to a combination between a balanced house view and also including hedge fund exposure in this portfolio. Here right to the left you will see the asset allocation of what I have called the standard portfolio, and here you will see the exposure when it comes to both local and foreign bonds and equities, property and so forth. Right here in the middle you will see the breakdown when it comes to our approach, the balanced house view with the inclusion of the hedge funds, and that is why you will now suddenly see things here like equity, directional, smart beta, fixed income, credit and South African, and diversifies when it comes to equity and of course soft commodities that you won't find here. Remember, these would be the 4 main asset classes we have looked at, and this of course would be the alternatives that we at Fairtree include within our portfolios. So if we just had to compare these two, this is how they would stack up, and you will see these orange bars here will actually then what we have in our portfolios that the standard one does not have, being represented by the green bars. Going back to what Sir John Templeton said about asset allocation and diversification, this really should give us the competitive advantage in terms of having alternative assets also in the portfolio. Let's see if this is indeed the case. Remember, this is a live case study, so this is based on actual information. In the top table, you will see the performance over 1, 3, 5 and 7 years of the standard portfolio, where we just mixed up the balanced funds from 5 different asset managers, and you would see the performance over 7 years. I'm using 7 years because this is a balanced blend. If we, however, had to compare it to our solution in the same space, having a different outlook on balanced investing, including alternatives, and making sure that we have a different take on diversification and really taking advantage of this, you will see that the return is over 10%. So this speaks for itself. It is absolutely outstanding, and it just goes to show that the assets being invested in, diversifying properly, will really give you superior performance at the end of the day. But how do we measure if a portfolio is truly diversified? What plays the biggest role to say we should invest in this and this should be the allocation? How do we actually measure this? And I believe my colleague Chiara has the answer to that.
Thank you, Salma. That is extremely insightful. So how do we measure if a portfolio is truly diversified? As we saw in some of those case studies that Salma has taken us through, it's not just simply picking different assets and putting them together. You'll remember inside our MDD document or fund fact sheet, portfolio sheet, remember they can all be used interchangeably in the industry. We saw that this section of the sheet, this stair-looking structure, was called correlation. And so how do we measure if a portfolio is truly diversified? This is where correlation comes in. So the key to implementing successful portfolio diversification is not simply holding different assets or picking different assets at random and putting them together in a portfolio, but you actually need to look at how those assets behave differently from one another. And so true diversification is having behavioral response differences to different parts or information that is received. So having a look at this in an emotional response, if we in the world were to receive a piece of news or a specific event or incident were to take place in the world and we all responded exactly the same way, if we all panicked or if we all went into overproductive, let's just all find a solution for this, the world would be a pretty chaotic place if all of our emotional responses were exactly the same to that piece of news. Diversity is extremely important to all areas of life. It brings balance, and that is true for the investment world as well when constructing a portfolio. So here we see a piece of news or an event taking place in the world, and we have a variety of different responses that create balance. Some people get anxious or nervous about it, and that brings a level of caution, like, okay guys, we need to assess some risks here. Some people get angry, other people get tired, they just want to take a nap and kind of sleep this thing off and hope that it goes away. You have some really cool people, they just play it super chilled, nothing really bothers them. Others decide to rather laugh it off and be the light-hearted, see the optimistic side of things. Some people start to analyze and overthink and have a look at all the possible outcomes that could take place. Some get really sad and they have a more sensitive outlook towards the news. And obviously we always get some of those Fruit Loops in the world. And so together we have a really balanced response to a specific incident or piece of news. And so much like this, we want the same effect for our portfolios. If a specific piece of news or information hits our portfolio, we want a diversity of responses to that information. We don't want our entire portfolio to go down or do absolutely nothing. We want a variety of responses. We want some to go up, some to go down, some of it to remain completely neutral because the news didn't really mean anything to that specific sector or industry. And so we see balance is very important. We don't want a portfolio that spikes really high in some season and then loses all those returns in another. We want a consistent return stream as much as possible. And so this is the concept of diversification. It's the spreading of risk without forsaking additional return. And so we just have this short video to explain correlation and what these different numbers mean inside this stair diagram when it says some is positive, some is negative, some is closer to 1, or some is closer to 0.
What is correlation? Monitoring correlation is key to generating excess returns. Correlation measures the degree of how much two securities move together or move oppositely to each other. The correlation coefficient is like a gauge, and it falls somewhere between -1 and 1. There are 5 types of correlation: perfectly positive correlation, no correlation, negative correlation, and perfectly negative correlation. Perfectly positive correlation is when two securities move together exactly. It is 100% correlated with a correlation coefficient of 1. Positive correlation is when two securities move similarly but not exactly, having a correlation coefficient between 0 and 0.99. No correlation means the movement of the one is not influenced by the other at all. Negative correlation is when two securities move somewhat opposite to one another, with the correlation coefficient between minus 0.99 and 0. Perfectly negative correlation is when two securities move exactly opposite to one another. They are 100% negatively correlated with a correlation coefficient of minus 1. So now that we have correlation and diversification, asset classes, and all these concepts in our mind, Salma, would you mind taking us through some of the examples from session 2 of some financial goals that we might have and how to actually accurately select an investment portfolio that will help meet those needs, achieve diversification, as well as selecting the correct asset classes to invest for those specific goals?